You were listening to chartingwealth.com for Tuesday, the 10th of November, 2015. We have crossed over the two-day trend line going down on the total market. We have a red down candle with a red down wick. We had some big power movements down. When we talk about the market, we're talking about IYY. This is where we always start. It is the iShares Dow Jones US Total Market, so it tracks the entire market, Total Market Index Fund. It's an exchange-traded fund. We track it along with the S&P 500 and the NASDAQ 100. Every day the market's open along with gold. We can see we have a coming together, a converging of the blue MACD line and the red signal line. We have our derivative oscillator losing speed. The market took a big hit today. If we go back and look at our 4-hour chart, for those listening by audio, I'll tell you what we're seeing. We saw a rollover back on the 4th of October, and we had the MACD crossover on the short chart going down, continue to track down on the 5th, the 6th, and the 9th big time, crossing over the two-day trend line the morning of the 9th, Monday morning. Big down moves. Market was down 0.78%. Two big red down candles with bottom wicks, no upward wicks at all, which means there was no upward movement as far as Ahinki Aashi type of Japanese candlesticks that we look at. Those are the kind that we like, find them to be the most accurate. And like we said, we have a red down candle for the two-day chart. That is for the 9th and going on into the 10th of November. That's where we are on the total market. Let's look at the S&P 500 as represented by SPY, another exchange-traded fund. This one is Spiders. S&P 500, Standard & Poor's 500, lots of volume in the market is what the S&P represents. Crossed over, actually was ended. This was an open red box under Hinkiashi type of candlesticks. Crossed over on our two-day chart back on the 6th, but really moved down through it on the 9th as the markets opened on Tuesday. Again, a down wick about the same size or a little bit longer than the down red filled box on our candle. We see, again, just like we saw in the total market chart on the S&P 500, a converging, not come together yet. Derivative oscillator also lost a lot of its speed. If we look at the 4-hour chart, looks very similar to the IYY, the total market, as it does a lot of the time, just because the S&P 500 is a lot of the volume of the total market. But we see it move down. S&P was down 0.94% for the day as opposed to the IYY down 0.78. So there's a little bit more acceleration down in the SPY has crossed over our two-day trend line. So we're down on the short chart and up, still up on the big chart, but a lot of power down movement. And of course, that red down candle on the big chart, something to pay attention to. Now, it could be just cooling off, ready for some more up moves, but we're way up at the top as far as our MACD goes. So we'll continue to watch very much with caution. As we told you on this last Friday, as we ended the week, we told you caution, market may be headed down. Now, lastly, as far as the indexes go, let's look at the Qs. The Qs have continued to move up, and again, it opened below the two-day trend line, but ended above it on the last two-day chart on the 6th. What do we see happen on the two-day chart? On the 9th, we see, of course, a huge break from the two-day trend line and a down move. Even more movement down that the bulls were able to push up. Bears were able to drag the market at least, it looks like almost twice further down than it actually ended up on the two-day chart. We see again a converging, a coming together of the MACD and the signal line, and a loss of inertia on the derivative oscillator. And again, the Qs for the day was down 1.05%. So much, well, not much. I mean, bigger loss than, of course, SPY at 0.94 and the total market at 0.78. Now, if we revert to our 4-hour chart, what do we see? Well, we talked about on Friday how we saw a lot of indecision at the end of the day where we had a doji, D-O-J-I, if you wish to look that up. It is a type of candlestick pattern where You have the market opening, closing at about the same spot, means the bulls and the bears are playing each other off. However, if you see the chart, you can see that, I'll tell you for those listening by audio, the down movement on the chart was much more than the up movement, meaning the bears were able to pull the market down further. The bulls were able to push it up, and the market, of course, pushed through, opened below the 2-day trend line as far as the chart goes, as far as the candlesticks goes in the morning, and continued to move down throughout the day. Bottomed out at about the same spot in the morning and the afternoon, somewhere around 112.87 on the Qs. It has been below. Actually, since the 30th, we've seen a rotating over on the MACD. Even though the market continued to move up, that was not sustained, of course, and it's rolled off with a huge down move in the derivative oscillator and a much more of a divergence, which means moving apart. And was I saying divergence earlier? I meant convergence. On those other charts. Diverging means moving away, converging means coming toward. That's what you see happening when it's crossing. This already crossed and continues to accelerate in its downward movement. So that is where we are on the Qs. All three of our indexes have crossed the 2-day trend line that we had previously established. They are all three down on the short charts. They are still holding on to gains on the 2-day, or upward movement rather, on the 2-day charts, but they sure do appear to be coming together. Now, lastly, let's look at gold. It was actually up for the day, 0.30%, but we always start by looking at our 2-day trend lines, and of course for the 2-day trend line, doesn't show that upward movement. It simply shows a red down candle. We're still below our 2-day trend line on that. If we revert over to our 4-hour chart, you will see that the market appears to have bottomed out. We talked about that possibility on Friday. Looks like gold has bottomed for this short time period. It's not yet crossed over going up on our 4-hour chart. That's the real chart we pay attention to. It's been a great chart for us so far. Crossed over going down back on the 19th of October. Continue to move down throughout that rest of the month of October and all the way through this November so far. Is it reaching a bottom? Could be. That is possible. We'll continue to see if that bottom holds, and we're looking for where it had bottomed around the same time before. Might have been back in August sometime, so that may actually be a bottom, may be a signal for us that it's reaching that same bottom it reached back in August. Just around 103.87 or so. So that may be. We have 2 green up candles, and those are filled green up candles. So we'll continue to watch those to see if that movement continues up. We can see that those green candles are typically strong, those fully filled green candles. We can look back in the past, although we have some instances where we had them. The market didn't surge back up again, so we'll want to verify indeed that we have a crossover on the MACD. Derivative oscillator is still on the 4-hour chart in the negative, but it is trying to catch up, and it looks like the MACD and the signal line are trying to converge, but that's not happened yet. So we'll continue to watch this potential bottom in gold. Might be time for an up move in gold. If you have been in gold on the down move, that is an inverse chart on your play money, as we talk about over and over, your virtual trading, because we do not give market advice for you to actually trade on. We're an education company. We're not a stock calling service. We do not take any responsibility, anything like that. We discourage that. We ask you to please learn how to trade with us. Once you learn how to trade and you feel confident, make your own decisions, that's for you to do. We are not a stock calling service. We in no way, in any way, encourage you to take anything we say to trade on. We do not take responsibility for that. We specifically opt out of any of that kind of liability. But hopefully you've been virtually trading and you got into an inverse gold fund or got out of gold, particularly when you saw it crossover going down back around the 19th of October. You've ridden it down. Be careful now to lock in potentially your gains. If you see this truly switch over and start moving up, you would have done quite well getting in somewhere around, let's see, the 113, 112 to 113 mark. Gold's gone all the way down to 104. And again, remember, an inverse fund goes up when the type of commodity or equity goes down. So might be a time to cash out when you read the charts properly and turn around and get yourself into an up trade in perhaps GLD virtually. So pay attention. Keep watching. This has been a great chart, our 4-hour chart in gold. If you don't have our charting layout from freestockcharts.com, that's what we use to actually chart. We use freestockcharts.com. The operative word there is free. We have our own layout that we've designed. If you'd like a copy of it, just email us. CW, that's as in Charting Wealth, CW at chartingwealth.com. We'll be happy to send that to you. You can also request our 15-minute, almost said 30-minute, our 15-minute how to read a stock chart video. We'd be happy to send that to you also. And guess what? Both of those things are free. Just again, email us cw at chartingwealth.com. We appreciate you so much being with us. We thank you for being with us every day of every month that the market is open. Thank you so much. You can follow us on Facebook and Twitter, also on Instagram and YouTube. And please be sure to listen to us every day. Subscribe to us on iTunes. If you want to really help us out, go to iTunes. First, subscribe to the podcast and give us a 5-star rating and say something nice about us. We do this for free, and we appreciate your support and your confidence in the good words you say about us. Thanks so much from chartingwealth.com.